Hello and welcome to the Jacob and Coffee Real Estate Podcast, where we talk about all things real estate over a great cup of coffee. Now, if you don't have a great cup of coffee in your hands, I want to encourage you to get one. In fact, don't just hold it in your hands. Why don't you take a drink of that? It seems like I retain information better with coffee. It seems like I convey information better with coffee. These claims are not backed by the FDA. Now, before we get started, I want to encourage you to like, to subscribe, and to hit that notification bell on this channel. Tell everyone about it, your friends, your enemies, everyone. And if you didn't watch our video last week talking about first-time home buyers, I want to encourage you to check out that video at the end of this one. I'll put a link in the description below. Now, today we're going to be talking about different loan types and what they could mean for you. This is usually how you're going to buy a house. Unless you have worked and worked and worked and saved and saved and saved for years to just lay cash down on a house, or have come into an inheritance by some rich uncle that you didn't even know, or unless you found buried treasure. Unlikely. But if none of these apply to you, you're probably going to have to find a mortgage lender. So there are a few different loan types that we're going to be talking about today. The first one we're going to be talking about is conventional loan. Now, conventional loans are probably the most popular mortgage that there is today. If you were to walk into your financial institution and apply for a home mortgage, you would probably come out with a conventional loan. Now, this is the old, I bring 20% to the table and the bank finances the other 80% that we've heard our whole life. Now, granted, it doesn't always have to work that way. You don't always have to bring 20%. In fact, the conventional mortgage is a little more flexible than what it used to be, but this is the loan that gets sold on the secondary market several times until it finally settles in one spot. I remember when I first had my home and I got my a statement from my mortgage lender. It was a different name on that envelope probably 2 or 3 times before it finally was the same one. And I know it kind of freaks people out, but this is how it is. Big financial institutions will buy packages of these loans to help relieve the financial burden of smaller banks or hometown banks. So that's why it's called the secondary market. They sell your mortgage to bigger financial institutions who can assume that amount of risk. But this is, like I said, one of the most popular loans today. Now, some of the pros of a conventional loan is that you can buy a primary residence with it, your first home if you want. You can buy a second home with it. You can buy an investment property with it. As long as you meet the requirements for the loan, you can buy any one of these home types. Overall, the borrowing costs tend to be a little bit lower. Your interest rate may not be as good as others, but the borrowing costs are going to be lower typically. And you can actually ask to have your private mortgage insurance, or PMI for short, to be removed if you've reached greater than 20% equity in your property. And you can actually pay as little as 3% on these types of loans as well. Now, some of the drawbacks of conventional loans is that you have to have a minimum FICO score of 620. Now, that may not be feasible for everybody right now. Maybe you find yourself coming out of a bad situation and your credit score is not where it needs to be. That's okay. Don't be downhearted because there are still options for you. We're going to talk about it a little bit later. But you have to have a minimum FICO score of 620, and your debt-to-income ratio cannot be more than 43%. So all the debts that you have cannot exceed 43% of your income. Now, likely you're going to have to keep your private mortgage insurance on your loan until your equity reaches 20%. Or higher, like we said before. You can remove it after 20%, but your financial institution is definitely going to want you to have that insurance there to cover their liability wrapped up in the property. And as with any loan, there's a bunch of documentation that you're going to have to bring when you apply. You're going to have to essentially tell them your whole life story. So if you don't like the fact that you're going to have to do that, then you're probably just going to have to just save up all the cash throughout your working lifetime, rent, live under a bridge if you want to, and finally pay cash for your home. But why would you do that? Who should get a conventional loan? If you have decent credit, if you have a decent job, and if you're like much of middle-class America, you could qualify for a conventional loan. In fact, a 30-year conventional loan is probably the most popular loan in America today. Government insured loans. The U.S. government is not a mortgage lender, but they make home ownership possible through other avenues. 3 departments, the Federal Housing Administration, the U.S. Department of Agriculture, and the U.S. Department of Veteran Affairs, all are agencies that back other loans to help make home ownership possible for other Americans. FHA loans. FHA loans are designed to help low to moderate income borrowers afford a home if their credit score is not what it needs to be to go conventional. So the minimum FICO requirement for FHA loans is 580, and that's to qualify for the 3.5% down payment that we all know FHA for. But you can have a 500 FICO score if you're willing to ante up to that 10% down payment. USDA loans. USDA loans are also for low to moderate income borrowers. Now, we may have all heard of rural development loans. It's very similar to the FHA program, but it is designed for things that are outside of the city limits and more in a rural area. That's why you get the rural development loan. Now, some rural development loans actually don't require a down payment for borrowers with low incomes. There is an extra fee, though, including an upfront fee of 1% of the loan, which can typically be financed with the loan, and an annual fee. VA loans. Now, the VA loan is designed to honor those who have or are currently serving in the U.S. Armed Forces. So if you have or currently serve in the U.S. Armed Forces, you would qualify for a VA loan. VA loans do not require a minimum credit score, they do not require a down payment, and they do not require mortgage insurance. Also, the closing costs can be capped and paid by the seller. So what are the benefits of a government-backed loan? Well, maybe you don't meet all the requirements for a conventional loan, but not all hope is lost because you have other avenues to get into your dream home. Because of the lower credit requirements, because of the lower down payment requirements, not all hope is lost for you. And they are available to first-time and repeat home buyers. So just because you use an FHA loan on this house means that you can still use it on another house. Now, there are requirements on how long you have to live in the house, but you can repeat the FHA process over your lifetime. So who might get this government-backed loan? Well, maybe you're renting right now and you think that you don't have the credit score to qualify for a home mortgage. I want to encourage you to talk to your real estate agent, talk to your financial institution, talk to somebody and say, hey, I'm renting. Here's my current situation. Do I qualify? Do you think I would qualify for some type of mortgage? Because I would love to be a homeowner. That's the American dream, isn't it? To become a homeowner, to have your piece of land, to be the proud owner of some property that you can kind of do whatever you want with. You can put your own touch to it and give it your own flair. That's kind of everybody's dream. Everybody wants that. I know that I grew up wanting that, and so many hundreds and millions of people want that for their lives as well. Fixed rate mortgages are pretty cut and dry, self-explanatory. You have a fixed rate for the entire life of the loan. These are the ones that typically go 15 years or 30 years. Some lenders will go in between there somewhere, but it is literally the same monthly payment every single month until the whole loan's paid off. So if you get a 15-year fixed, you're going to be paying the same mortgage payment for 15 years. But once it's done, your home's paid off. This is also a popular home type for people who know they're going to stay in an area for a little while, around 7 years or more. They want this type of mortgage. Why is that? In this type of loan, your fixed payment, when it's coming out every month, when you go to sell, you're going to realize you actually have quite a bit of equity built up. Now, that is if you have lived in it for a while. If you're only going to live somewhere for a couple years, you're moving there for school, for a job that you maybe pans out, maybe not. I don't advise. Well, I'm not an advisor, but you talk to your advisor about whether a fixed rate mortgage is for you or not. Adjustable rate mortgages. Now, these ones are less common to the everyday American because they involve a little more risk. And here's why. You only lock in an interest rate for a short period of time. Now, short comparatively to the other mortgages that we were talking about earlier. This mortgage rate is only locked in for a few year span, 5-7 years. And at that time, the loan then begins to go with whatever interest rate is current. So if you have a 5-year ARM, that interest rate will be the same for the first 5 years, but subject to whatever the market says after that 5 years is up. But you may think, why in the world would I even want one of those? Now, you may be in a situation of your life where you move somewhere for school, and instead of going to an apartment building, you decide you want to buy. If interest rates are in your favor, you could lock in a favorable interest rate in a 5-year ARM and save a substantial amount on your interest payments over the short life of that loan. Now, there's a certain level of risk involved because if by any chance you should stay longer than you intended, you are then subject to whatever the current market conditions are regarding interest rates. If they are way up here, well, then guess what? Your loan shoots up to that new interest rate, and it's not locked in after that period expires. So they are very functional loans. They may not be for you in your situation, but there's something to have in your back pocket just in case one of these different situations are applied to you. There are other types of loans that we're not going to cover today: construction loans, piggyback loans, interest-only loans, balloon loans, private loans from a wealthy individual, or even grandma and grandpa holding a loan for you or holding the note so you can pay them off over time and eventually become the homeowner. But my point for this video is to tell you, because you don't have the cash in your pocket or in your bank account today, does not mean that you cannot become a homeowner. So if you're watching this and you're thinking of how great it would be to own your own home, talk to a mortgage lender today and ask them what your options are, because you might be surprised that you have an option for you that could get you into the home of your dreams. As always, thanks for listening, and make sure to take life one cup at a time.